Every company in this series had something worth taking. Red Lobster had real estate. Sears had brands. Toys R Us had cash flow. This file is about a company that was valued at $47 billion, more than Ford at the time, while owning almost nothing, earning less than nothing, and losing more money with every dollar it grew. WeWork never had assets to strip. What it had was a story. And this is the file where we watch a story get valued, leveraged, extracted, and liquidated exactly like a building, because in the end, the founder walked away with a package worth around $1.7 billion. His biggest investor lost more than $14 billion, and the company went bankrupt. Everyone lost except the man who told the story. This is the liquidation files. Open the folder. Start with what WeWork actually was, stripped of every adjective, because the entire saga hinges on this. WeWork signed long-term leases on office buildings, 10 to 15 years, renovated the floors beautifully, and then rented desks and offices on short-term contracts, month to month, year to year. That's it. That's the business. Buy long, sell short, pocket the spread. It's a real business. A company called Regus had been doing it profitably for decades. But notice the shape of the risk. WeWork was locked into its rent for 15 years. Its customers could leave in 30 days. In good times, the spread is profit. In a downturn, the customers evaporate and the 15 years of rent remain. WeWork wasn't a technology company. It was a landlord-tenant mismatch wearing a hoodie, a company whose core product was holding the exact risk its customers were paying to avoid. Enter Adam Neumann, co-founder, chief executive, and one of the great salesmen of his generation, by the account of nearly everyone who took a meeting with him. Neumann didn't pitch desks. He pitched a revolution. WeWork would elevate the world's consciousness. It wasn't office space, it was community. It wasn't subleasing, it was a platform. And in the venture capital environment of the 2010s, awash in money, starved for the next Amazon, the story worked. Round after round, the valuation climbed. Then came SoftBank, the Japanese giant with a $100 billion fund and a founder who famously prized feeling over spreadsheets, and the numbers left Earth. By January 2019, WeWork was valued at $47 billion for a subleasing company that was losing billions. And the money didn't just inflate the company, some of it flowed in directions this series has trained you to notice. It was documented in the company's own filings and reporting that Neumann had personal stakes in buildings that WeWork then leased, making the CEO in those deals effectively his own company's landlord, collecting rent from the business he ran. If you've seen our Sears file, you recognize the position. The company had also paid $5.9 million for the trademark to the word "we," a trademark controlled by an entity connected to Neumann himself. After public outrage, he returned that money, and ahead of the planned public offering, Neumann had already cashed out and borrowed against his stake to the tune of hundreds of millions of dollars. None of this was hidden, exactly. It was sitting in the paperwork, waiting for someone outside the true believer bubble to read it. In August 2019, someone finally had to. WeWork filed its S-1, the disclosure document every company must publish before going public, and for the first time, the story met the spreadsheet in public. The spreadsheet said, billions in losses growing as fast as revenue, and tens of billions of dollars in future lease obligations against a small fraction of that in committed revenue. The document even featured an invented profitability metric, community-adjusted EBITDA, that made the losses look smaller by excluding essentially the costs of running the business. The governance section was its own horror show, shares giving the founder 20 votes each, control provisions unlike anything public investors had seen. Wall Street read the S-1 the way you would read a home inspection that lists the foundation as aspirational. Within weeks, the offering price collapsed, the offering was pulled, Neumann was out as CEO, and a company valued at $47 billion in January was rescued by SoftBank before the year ended at a valuation of roughly $8. Now, the part of the file that made this story a scandal instead of just a failure, the exit. To take control and remove Neumann, SoftBank agreed to a package for the founder, stock purchases, fees, and credit, reported at around $1.7 billion. Read that against the timeline. Thousands of WeWork employees were laid off in the aftermath, many holding stock options that were suddenly worth little, while the man whose choices defined the company negotiated a 10-figure goodbye. It became the era's defining image of failing upward, and it happened before a single pandemic lockdown, which matters, because the pandemic gets blamed for WeWork, and the pandemic only finished what the S1 started. COVID did, of course, arrive with almost comic cruelty for a company selling shared office space on flexible terms. Every customer who could leave left, and the 15-year leases stayed. WeWork limped public anyway in 2021 through a SPAC merger at $9 billion, a fifth of its peak, and kept losing money every quarter. In November 2023, it filed for Chapter 11. SoftBank disclosed losses on WeWork totaling around $14.3 billion, one of the most expensive bets in venture history. Landlords across America were left holding the mismatch WeWork had been built on. The company used bankruptcy to tear up dozens of leases, shedding roughly $4 billion in debt, exactly the way our retail files shed theirs. And here the story takes its final, very on-brand turn. Neumann, watching from outside, offered more than $500 million to buy WeWork back. The company said no. It emerged from bankruptcy in 2024, cut down to around 330 locations, majority owned by Yardi Systems, a real estate software company, run, at last, by people who think of office space as office space. Quietly, the slimmed-down WeWork still operates today. The product was never fake, the price was. As for Neumann, he's back. His new company, Flow, applies a familiar vision, community, connection, this time in residential real estate, and it's backed by the venture firm Andreessen Horowitz at a reported valuation around $2.5 billion. After the bankruptcy, Neumann called it disappointing and said it had been hard to watch the company fail, as he saw it, to capitalize on a product more relevant than ever, his consistent position being that WeWork's collapse happened after his departure, under other management through a pandemic no one chose. That's his account, and the record of what happened on his watch, the S1, the related party deals, the losses, is also the record. You've watched 9 of these files. You can weigh it. So what does WeWork add to our shelf? Something none of the retail files could. In every previous file, the extraction needed an asset, buildings to sell, real estate to split, cash to dividend out. WeWork proves the machine runs on pure narrative. The story itself, the revolution, the consciousness, the platform, was the asset. It was inflated like a property value, borrowed against like a building, monetized by insiders like a sale-leaseback. And when it finally collapsed, the losses landed exactly where this series has taught you. They land on the employees holding worthless options, the landlords holding torn-up leases, and the investors holding the bag. The person nearest the story's origin walked away wealthiest. The $47 billion was never really there, but the $1.7 billion was. One last number for the file. The boring subleasing company that WeWork always actually was, the one with 330 locations and a software company owner, may yet survive indefinitely, which means the most expensive thing about WeWork was never the business, it was the story taped over it. If you want more files like this one, the companies you grew up with, the stories you were sold, and the paper trails underneath them, that's what we do here at the Liquidation Files. The next file is already open. I'll see you in that one.